Mexico City. I think that's a great topic to start the conversation with. Forget all the other things, insurance, wearable, the transition away from wearables to, and how long have you been in Mexico City?
It'll be 4 years this year. Yeah.
So kind
So
of like the COVID change, or?
yeah, I came, right after COVID and stuff started opening up. I came down in 2022 and came for a wedding and just loved it. The weather, as I mentioned, I was living in San Diego, and San Diego is beautiful weather, but I would say
Yes.
Mexico City is nicer. And there's no beach. That's the downside, but it is 75 degrees and sunny year round, and just absolutely wonderful culture and people, and couldn't be happier.
I heard so many good things about Mexico City, and I was invited so many times. I think that I have like the Zurich thingy there from the Zurich office from Mexico City, and all kinds of
Nice.
other things. And I was like invited there so many times, and I've never been to Mexico City. I've been to other locations, mainly Oaxaca and kind of things like that, but yeah, no Cancun and no Mexico City, and the culture, the food. Well, 20 million people.
Yeah.
It's like, yeah, no,
15% of the population of the whole country's here. Yeah.
wow.
It's remarkable.
Is it bigger than Sao Paulo or La Paz, or
I'm not sure about those two. But it's interesting. It's a very large city in a huge valley. And unfortunately, though, you don't really explore the breadth of the city. You tend to stay in somewhat of a zone, towards the center of the city where most of the things are. But the city just goes on forever.
Well, we can say that for almost every city or, major metropolitan. Even here, Los Angeles, there are places that unless I really, 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 really have a good excuse to go to, I will not leave my, because it's just not efficient. Well, it's like, are you kidding
And the
me?
and the traffic in Mexico City is, much worse. It can be. I've spent in my neighborhood going. I remember 2 kilometers. It took me 2 hours to go 2 kilometers in traffic one time. So it can be rough.
Yeah, I'm going to repeat it. Well, I will skip the story of Boeing Company and how brilliant Elon Musk is, and how he made people sit in traffic to reach one of his events, and just so they will go like, yeah, we need your solution, please. Because LA traffic is notorious. However, when you are actually traveling and living in mega cities like Mumbai, Mexico City, you really feel traffic. Here, we just like to complain because we see, well, now the gallon, the price per gallon is more than $6. So we even see our bank account drops as we sit in traffic.
Yeah.
But jokes aside, Adam, thank you very much for joining me to the InsurTech Talk. Let's talk about insurance and things that are, well, will be a little bit more interesting, although Mexico City is very interesting by itself. So, Kinetic, last time I had on this podcast, it was Item, and most likely I'm mispronouncing his name again. That was 4 years ago.
Yeah.
Yeah, things change. What's new? What's new with Kinetic?
Yeah. Well, thanks so much for having us on again. Really appreciate that. We're still a monoline workers' comp MGA, focused on bringing value in between the brokerages that we work with and the capacity partners that we partner with. But a lot has changed in 4 years. So 4 years ago, we would have just started the MGA. We would have been 4 months into seeing how our journey was going to go, and probably crossing our fingers, but that was about it at that point. And today we're north of 100 million in premium. We've been doing really well, profitable underwriting results, and the way we've been providing value has changed significantly. When we first started, as I mentioned in workers' comp, we really came out of a wearable device company that had been selling that product into large self-insured customers. And we brought that product into a workers' comp product for mid-market customers. And through the years, what we saw was that really not just wearables, but any prevention technology in workers' comp ultimately requires the policyholder and or the broker to do quite a bit of work or changes to get the results out of a prevention product. A prevention product inherently is giving you data typically and saying, hey, we see these leading indicators that, you should respond to this data and go retrain your staff, go fix, something that maybe is identified with computer vision. But they require an extra bit of effort that I would say is just challenging to get full implementation and usage and quality out of. And so about a year or two in, not too long after probably you first talked to Hatham, we started to see that and really started to see the need in our business was the ability to service problems that were happening in the current experience. And with our customers, that really became claims oversight. Mid-market customers are 500,000 in premium. They have claims. These are, sizable businesses. They're not large Fortune 500 businesses, but they're 50 to, 2,000 people. And so they have claims. They want to control their risk. Their premium costs a fair amount of money. And we saw this need that there was a huge amount of data. And I think I've heard you talk about it. Insurance is a data business. And we saw this huge potential for taking that data, fusing that data, and really creating insights and actions we could do that were being missed at the broker level or missed at the adjuster level on the capacity side, and servicing those to our team to take actions on or to the policyholders to take actions on. So that's really been the big shift with Kinetic is we've become much more of a software-based claims oversight system than a wearable device system where we first started.
Now, is the website still Wear Connect, or did you change?
No, we changed that. With these shifts, we had to evolve as well. So it's KineticComp.com.
Okay.
If you can still, I think, go to Wear Kinetic, which was very wearables associated, but it redirects to Kinetic Comp. And so yeah, and all of our email signatures are also now updated. We've gotten that feedback. So yeah, full branding and really kind of a re-evolution of the business in terms of what we're focusing on and how we bring value into the system.
So here's the thing. I love this because it's a textbook or a classic use case of the evolution of a startup to becoming a mature company. There was a thesis or hypothesis, you test it, it didn't go well or as expected, there was aha moment, we pivoted, and now we are on the right path. And with that, the small nuances, it's like, yeah, we need to rebrand, because while we started as a wearable, today we are workers' comp, and we are focusing on data. And the great Kinetic, where Kinetic doesn't work anymore. And I've seen people later on spending so much money on changing the domain name, which is insane. Paying, 5, even 6 digits on the right domain name, because that was part of the marketing. It was better understood by the right type of investors than others, why you need to spend so much money on buying a domain name. But that's just a symptom or a small checkbox action. They're part of the to-do. It's like, okay, get the right domain name and move on. In the bigger shift that you're actually doing, it's quite remarkable. And if you don't mind, can we talk more about it before we get into the small nuances of insurance which are weaved into it?
Yeah, absolutely.
First of all, how did you recognize that wearables don't work as expected?
So the funny part was the wearables work great. It is the change management of really, and it's not just wearables. I would bucket almost every prevention technology in workers' comp has a serious change management component. So the technology usually is very sound. Computer vision can detect, forklifts speeding and going into keep out zones and lack of machine guarding. Wearables can detect strain and sprain motions of leading indicators where, the body is getting out of line and people are bending over and picking something up without bending at the knees. Apps can kind of surface things like, best case, post-injury checklists and, stand-ups for safety before you start a shift. But at the end of the day, what we've seen is all of those, they tend to be very effective if they're implemented. The challenge is not so much the quality of the technology. The challenge is much more the change management at the business level and the incentive for the business owner to make that change. And I would say in infrastructures that are self-insured, like big Fortune 500 businesses, they have those infrastructures. But as you move down the spectrum to smaller and smaller businesses, and we're still good-sized businesses, but even as you get down to our size of mid-market, you don't run into those same infrastructures. You don't run into groups that are as savvy with data and can understand how to use data to make changes. And you run into groups that are much more skeptical around proof points in data. So I always compare our devices in insurance when you're dealing with some of those customers as you're selling phantom benefits. You're selling a benefit that you have to go to a customer at the end of the policy and say, trust me, you avoided, 2 injuries or 3 injuries because you use this product. That is not a compelling sales effort. and it's very challenging to keep, continuous adoption. And at the end of the day, it just became very expensive to keep continuous adoption and usage. And so we still have devices out there from the early days of when we launched in insurance. We use about 4,000 to 5,000 devices on a daily basis. But very quickly we saw, if you just ask the customer, what do you want help with? They typically will point you to, I get what you're doing and it's nice, but it creates a lot of challenges on my end. I'd rather you help me with the problems that are already in the system that I can see right in front of my face. And in our size business, that is very much, I have a claim. Is it being managed well? Are the reserves accurate? Can I do something to make this claim close faster? Can I do something to make this claim close at a lower cost? Can I provide better value to my employee during the life cycle of the claim? Those are the things that really come to the forefront when you talk to them about what's broken in the experience.
I think that, first of all, very well articulated, because, and it's one of the biggest problems that we see, not just with startups, but it's kind of the irrational thinking as human beings, because it's very hard to calculate the missed risk, right? Prevention, if the accident or something bad didn't happen, how do you even calculate it? It doesn't register with you because it didn't happen. It's even now in different investment things that I partake, it's how can you explain? It's like you don't go into a certain position because you may lose, or there is a certain calculation that you need to put emotions aside and just focus on that. Is it in the guardrails or my formula, right? And when it comes to insurance or anything like that, it's like, if you don't see, if the prevention or the concept of prevention in insurance, it's very hard to grasp because there wasn't a claim. So how do you know? Can you
actually say, you can see it over time, over time you can see premiums go down.
But it takes years. Yeah, but
exactly. That's the problem.
And then you need to understand, it's like, okay, so I have this specific individual or business, right, entity, and we have the bucket of different entities, and they are in bucket risk number A. Now, if we use this solution, is the bucket change the label of risk? Did we manage to change? And it takes a few years to understand that as a loss ratio. That's basically the best that you can do. It's like, do we have the claim now?
And I would say the key is between successful and unsuccessful prevention technologies, because I do think telematics is fairly effective. I do think flood insurance is very well done with sensors. I do think there are pockets, but the difference that I've seen is you have to consider the cost during that time to whoever's implementing, and not cost from a, what does this sensor cost me? Cost from a change management, and what do I
Yeah.
have to educate my employees on? What do I have to fight from an employee acceptance standpoint?
Oh, your
That's a
political
cost.
capital.
Yeah, exactly. And so that's where I think Flood has done really well with sensors, because there's no political capital. You put a sensor on a pipe, you can detect a leak. That's not political capital.
No,
But when you put telematics on a truck and you have to, argue with a truck driver who's saying, this thing isn't working, or you put a wearable on a person and you have to continuously train them, why is the wearable collecting data, what it's not doing, when you have to put computer vision in a warehouse and, go through the, hey, here's this recording you every day, and I see these, and go through that barrier of employee
tell
interaction
me
and
more
change
about the
management.
big brother. Yeah, tell me more
Yeah,
about.
yeah.
Are you
That
are you
has a
checking?
cost over those years. And that's the challenge. And so you either have to have an incredibly high ROI that's super fast, like your premium next year is half the cost. Then you could get over it. But that's challenging. These are usually incremental. There's no silver bullet here. And so that's what ends up being the challenge, I think, in prevention technologies.
I will even add. I love the truck example because it relates to two things. A, we don't like to be monitored. You think about freedom. This is against the essence of this country, and kind of liberties being taken away slowly and surely, usually in the name of security, and in this case, safety, right? So you
Mhm.
cannot do this, you need to add the monitoring for that. And then there is the other element of the monitoring. It's like, okay, so if I put that wearable, you know everything about what I'm doing, when I'm taking a break, when I'm taking just a breather to get my mind set. So it's like, there were places that check the keystrokes. Are you sitting enough? Not working,
Mhm.
punching in there. Then people will just create solutions that will mimic just random keystrokes and
Yeah.
phantom emails just to feed that into the system. But that's part of human nature. There is the random element of life. But at the same time, there is the most important thing, which is the gratification of, we want to see that what we bought, the service that we bought, is actually doing something. I need to get, and I love the fact that you pointed out that it's a 6 months window. Most of them, loss ratio will take a year or maybe
Yeah.
quarters
And I
internally.
mean, we're in workers' comp. It's 5 years,
Yeah.
so
Oh my
it's a
God,
long
right.
tail, So yeah, it's even harder in workers' comp. At least auto, you can see it faster, property, you can see it faster, but
Yeah,
it's a very long tail.
but with auto, especially with the trucks, and that was the second point, it's like it's against the incentives. The trucker wants to drive faster. The trucker wants to unload and start his next ride, his next haul, as fast as he can.
Yeah,
Because
productivity versus safety is always a challenge in workers' comp, because you're usually fighting. I mean, there's a lot of studies that would show on the lifting side, you actually can be more productive over the long run, but that's never the way the worker receives it. They don't see it as like, I'm conserving energy to be able to last longer. They say, no, I have to, take longer now to do this single task, and this is not as productive. And most of my bonus is related to productivity. It is very rarely related to safety. And so you're just fighting an uphill battle. And at the end of the day, I mean, all of this is solved, to be honest. We just talked to our customers, our brokers and our policyholders, and, very quickly found out, well, what is it that makes workers' comp just so average? It's a commoditized product. You have to buy it, but it's $500,000, $1 million a year. Why do you switch from one carrier to the next? And what we heard over and over again is just, everybody is a pretty piss poor experience. And
Mhm.
what I really need help with is knowing that the experience is better and my claims are overseen in a much tighter and more aggressive way. And we saw an opportunity to do that with data fusion and software.
So I'll promote my wife for a second. One of the courses that she is teaching at UCLA is corporate incentives and compensation. And it's a second-year elective course in UCLA MBA. And the thing about it is, how do you set the right incentives that will work? So as you said, productivity is very important, but how do you set incentive on a safety that doesn't bring you to collecting rat's tails, right? I'm sure that you're familiar with the story. It's like the incentives like, hey, show us that you collect a lot of rats and kill them by bringing us the rat's tails. And what happened? People just create rat. They have farms to have as many rats as they can, so they can go back. What was it in India with the British? They go to the British or the French, whatever, somewhere else, pick the wrong incentive. Here are the rat's tails because we have farms now, so you're going to pay me more. And so how do you actually measure safety or accident avoided and not create someone who go like, I'm going to start accidents. I'm going to have as many accidents and not having them because it didn't happen. And you're going to incentivize me for not having that accident that never had happened. But let's go back and talk about data. So Wearables, which has its own little challenge of being a hardware startup and moving to software and data. How was the shift? And you still have a little bit of a tail with the hardware. You're not.
Yeah.
I assume that you're not manufacturing hardware anymore, just kind of supporting the firmware.
Yeah, exactly. The shift has been prolonged. We didn't do it overnight. We had a product that worked very well. So I think, pulling the plug on that was not something that we said, hey, we're going to, do very quickly. It's going to be a very concerted effort. We want to see the results in a software-based approach before we make any of those types of decisions. So that naturally made, I think, the shift much longer. And then, a lot of it has been the focus of our teams. I'd say a big one is we have an internal account management team, and they used to be 100% focused on hardware adoption and usage. And really, I would say the way we changed our system and really found success was we started really winding them down from the hardware adoption and usage focus and ramping up the software usage and impact focus with our accounts. And so as we took that team and drove the incentives more to keep your eyes on the claims oversight, the data, and the ability for us to impact these claims, and less on the usage and utilization of the hardware, that really helped us through that transition into being much more of a software-centric business. So I would say it came down to what you could call customer success in that system.
Oh, cool. That's focusing on the customer. That's the goal of every company. You need to focus on the customer success and align yourself with what they want. And it's so hard. Sometimes we have this notion of it's like, oh, I know better. Well, Steve Jobs and a few others knew, you don't know what you're doing.
Right.
Let me tell you how you should use what was it? The iPhone 4, the iPhone 5 that it kind of explained people that you are holding the phone wrong. But that's the opposite example of where I'm going with this.
Yeah.
So now, sorry, go ahead.
No, totally agree. I think there's some areas where I think we still have opinions of you don't know what to expect. And so we're going to tell you what to expect because we do live in an industry. Insurance is an industry of mediocre, in my opinion, especially around customer experience. And so I think there is an avenue where you do have to push a little bit of what this customer experience can be for a broker and policyholder, because if they baseline off of everything else they've seen, just like in the iPhone, they just haven't seen the difference. So it's very hard for them to extrapolate, what, the best experience would be. But I agree. Most of it, at least from a focus area, is driven by the customers. Maybe not the end solution might not be, but the focus areas are very much driven by the customers.
So let's talk a little bit more about the insurance, if you don't mind. You're an MGA, you've been selling insurance properly. who is the fronting, if you can share, or the structure with
Yeah, absolutely.
seeding?
Yeah, so we were very fortunate when we got started. Even when we first talked, Nationwide Mutual was an early investor in our wearables
Oh,
business.
nice.
And we got connected to them when we wanted to set up an MGA. And they have been a phenomenal full stack partner, which means we don't need a front and reinsurance panel. We don't have to, go out and constantly find new quota share partners or whatever it might be in those
Hmm.
systems. And we don't have, a million pigs at the trough eating into whatever margins are left as an MGA. And, and so we have done the majority of our growth. We have a couple other capacity partners, but the clear majority has been with Nationwide, through this 100 million and continuing. I mean, we have just lots of support. We actually write at this point, we write 25% of all the workers' comp that goes through Nationwide, both across their
No
programs and,
kidding.
yeah, across their programs and across standard commercial, which is their own internal comp business.
That's impressive.
Yeah, we write over a third of what goes through all of their programs business, and they have 15 other programs. And so we have just really loved the partnership. Now that being said, that has pluses and minuses. Have been greatly supported, but we're also, the way we blow is the way the whole P&L blows at Nationwide Comp, and especially in their programs. And so I think we're both sensitive to that. And we're constantly, thinking about strategies there. We've talked about, as we've gotten so big with them, reinsurance partners on their side. But we've been very fortunate. We have had a full stack carrier the whole way through.
Is it Brian the main guy, or was that before he became a partner?
Brian is on the venture side.
Yes.
And then and there's very much, I would say, a wall between ventures and once you start working with their business. And then on the business side, we work with Amber Wayne, who's kind of head of E&S, and Dale Hoppy, who manages all the work comp programs.
We'll try to give props to everyone and shout
Yeah.
outs and thank you guys.
Oh, they've been
Um,
great. They really have been. I mean, it's a phenomenal team. They really know insurance from an investment side, and then on their program side, they've just been phenomenal partners in helping us. Look, we've gone through a lot of lessons learned. I mean, we transitioned the whole business, just like we said, and I think that can be concerning to some partners. Some partners would look at that and go, "Hey, that's not what we formed this around, and we're not going to keep supporting it." And they've just been really understanding of the adaptation, the ability. We've had very good underwriting results, so I think that's helped. But we've just had a great working relationship there.
were you guys at the beginning at what was it, 500 startups hardware accelerator, or I'm confusing you with someone else?
Yeah, we did Techstars
Techstars.
back in. I mean, this was back in 2014, 2015.
Oh, it's been a few days. No
Yeah,
kidding.
yeah,
That's more than
10
10
years.
years. That's like,
Yeah,
wow. That's
it was.
12 years.
Yeah, Techstars. They had a hardware batch that was very specific to hardware in New York City, and we went through that. And like I said, all of our early investors were hardware investors. I mean, not only did we have to transition our capacity partner through this shift, but we had to transition all of our early investors, and I'd say we had some timing on our side. We did that around when I joined in 2020, we did it shortly thereafter in 2021. Where we started laying the groundwork. And if you remember back in 2021, MGAs were trading at 10 times premium.
Yeah.
So there wasn't those, at
That
least
was
the investors
easier to digest back then.
exactly. For
And
general investors, it was very easy to digest.
yes. Yeah. And then you still had like a little bit more runway for VCs and the excitement in 2022, and then desert since 2023, especially for the venture side. And it's going to continue unless you are very successful with a lot of track record on the venture, right?
Totally.
It's
The
interesting
generalist,
time.
I was just talking to a partner at FTV Capital, which does some very big growth
Mm-hmm.
investing in MGAs. They have 4 MGA investments and a really nice thesis. And we're fortunate enough to be at the stage to talk to groups like that. But the way we really see it is there's a very small pool of investors that really know the space that I would say touch MGAs now. There's a generalist pool that still touches a lot of software-based broker solutions. So that you tend to see more venture capital and early stage stuff on the brokerage side, but then a lot of generalists play there. So it can be a little bit tricky of really like what you find out there. And then there's literally you probably count them on two hands, like the pool of investors that really know and touch the MGA space. And then nobody touches risk bearing. Forget that. Like if you're not, if you're not a $1 billion business these days, you're not getting a risk bearing investor.
It's interesting because we are recording it kind of noonish Pacific time. My two early calls this morning was one with a PE, another one VC, and it's different. So with everyone, it's about the fact that software is dead. At the same time, AI is killing everything, but not all AI is AI. And then with the PE is like, yeah, but we are still looking for software and services, but software is dead. However, if it's a good software, we'll still look at the software. And by the way, do you know we are looking for companies who are serving evacs, plumbing, and all that stuff. Now, those specific guys, they have like 14, 15 billion AUM. So it's a little bit different, and they have the different sectors of the stuff. But it's like, okay, so what changed? It's like, oh yeah, no, the EBITDA and the minimum ARR, that range changed a little bit. So it used to be a joke. We all want to invest in Google, or it used to be a joke. Now it's everyone wants to invest, I don't know, in OpenAI, or whatever that may be. It impacts insurance as well. And while saying that, you can count on one hand the investors, the specialist investors that will do capacity or risk-facing startups. And by startups, that's the biggest problem. The early stage is hard. It's super hard. But it's part of the industry. It's part of the game. Yeah, you need to know how to do that. It's not easy. Well, if it was easy, everyone would do it, right?
Yeah.
So you had a couple of great. So if you are one of those startups that are now trying to figure out, well, we've been running a brokerage, and now we would like start to do the vertical integration. Should we launch our own program, MGA, or should we'll just launch an MGA out of the blue, clean slate? How do they work with investors and capacity providers? What would be your tip? We talked about tips earlier on and how you should never listen to someone else's tip.
Yeah. If I were starting an MGA from scratch today, that's a very interesting question. I think, like I said, there are some niche investors that really understand the MGA space, but it's very limited. I think most of the generalists don't touch the MGA side because they don't have confidence or really know how to analyze the underwriting advantage and the underwriting results and the extrapolation of underwriting results. You really have to be pretty savvy in insurance to really understand those things. So I would say one is, don't waste your time, going to all the investors out there. Like I'd be pretty focused with who I was talking to that really understood and had MGA investments. And there's some good, there's some incubators now with MGAs. I think, Equal VC has a specialist, Adam, that has talked about MGAs in the past and stuff they've done on that. There's there's another group, I forget, David out of New York, that's got like a MGA incubator. Yeah.
InsurTech New
So
York,
there's
they have their MGA program for startups. Yeah.
right. So I think finding those is pretty critical. Find like kind of the right people that have seen them at the very early stages. And then I think the other thing is you have to have a very sound story around the underwriting advantage. That's the key thing. I mean, every time we talk to investors, even at our scale, 100 million plus in premium, they're if they know MGAs, they're honed in on explain to me, the underwriting advantage and the loss ratio impacts that are going to happen here, because they know that these things, as we think about the capital value or the enterprise value of our business, these things don't trade on premium. They trade on health of capacity relationships, which will be driven by your profitability and your shared partnership profitability. And they are driven by the cash flow in the system. I'd say those two things really dictate your sale value or your acquisition or even IPO propensity. And those are both directly dictated by the underwriting advantage and the loss ratio results. They have nothing to do with, yes, there needs to be a market enough that the premium size applied to that will have an outcome that's advantageous. But most insurance, there's a line for, a fair amount of premium. And so I think that's the key is you've got to nail that part of your story and then partner with the right groups at the early stage. That's how I would do it.
Allow me to add, as a guy who reads a lot of investment decks, don't give me the $6 trillion market. I don't want to see the 10.
Yeah.
It's important to understand the TAM, and kind of one of my, not rejects, feedbacks to one of my clients now that I told him, it's like, first of all, I love the fact that you're just pointing out to whatever a few $1 trillion in a certain industry, and which is there is a correlation, but it's not really exact where you're going. Start with, okay, what is the real potential? If you're selling, for example, and I cannot really disclose all the information, but let's assume what we are talking about. The workers' comp, great. Let's talk about workers' comp as an example that specializes in warehouses or nursing homes. How many nursing homes are there? That's your TAM. Let's start with that. And then let's talk about where can you actually write and who you can serve and how are you going to serve them? Because, the SAM, the SOM, but when it comes to a later stage, right? Not early stage. Well, if Series A is, but not seed. Seed, grow, speculation. Series A, you need to start show a little bit of mastery, a little bit of fuzz on your face to show I'm reaching a certain maturity. Series B, you know your unit of economics. You need to know if the black box, if you give me $1, I'm going to pop up $1.6 in a year. You already mastered that. So we know how to scale it. Series C is even better, right? Now you need to show me if I put $1, you're going to make that 1.6 in 9 months or 1.7, 1.8, whatever that may be. But if it's earlier, especially in the A to B, need to show maturity in terms of understanding what's the real market and how are you going to accomplish. A lot of people at the beginning are too theoretical, too hand wavy, in terms of how they're going to do that. And when it comes to insurance, and you actually talked more on the behind the scenes of insurance, the thing that most people don't understand, the relationship with the capacity and the reinsurance, and how you use how many pigs are on the trough. But which is it's a good analogy because you have so many commissions and fees, and only for the paper you need to have between 5 to 7%, and there is so much to understand, and it's important because you need to know how to spread the risk around, so not everyone will get hammered and etc. But when it comes to insurance, and it will be a great segue, for the next question, is like, it's all about distribution. Can you sell insurance? We'll know about the risk and the marketing if you know how to target and get in good risk and not bad risk that will turn into a claim in 2 months or in less than a year, or average of 2.5 years for car and 7 years for home or whatever.
In our business, it's probably more like
you sell?
the first week, so, you can see a claim.
And that was the end of a workers' comp. Yeah.
No, I agree. We've been, distribution for sure. That is key. There's a really sharp guy I met. I want to say his name's Eric at Bullfrog Advisors. I don't know if you've talked to him, but he sold his business API Intego to Next, and it was all a distribution strategy. And he's a brilliant distribution guy. And in comp, we've been very fortunate. We went to a segment that it was all coming through established brokers, and the brokers have these big existing books. We didn't have to reinvent anything on distribution. Now, the groups that have tried that, I think, have actually reversed those strategies. The especially in comp, the Pies of the world, the Next of the world, they tried a lot of this. We're going to reinvent distribution and go direct. And from what I understand, that did not pan out. Those relationships have all transitioned back to brokerages. So I think, I will say, if you're starting an MGA with a unique distribution strategy, and when I say unique, maybe I mean unproven, that is probably dead in the water unless you've got some real proof points.
Everyone is focusing now. Everyone is back to brokers unless you're doing a very smart embedded insurance platform and you own the channel.
Right.
And that channel, usually you're going to find a channel that is a massive channel and you're going to embed yourself there. So you are part of the valve, you are part of that pipe. Otherwise, it's super, super hard. But everyone is kind of, we try to go direct. We are paying a lot of money to Google, Facebook, God knows what else.
The distribution, I will say when we first started, the distribution was interesting for us because we brought a very unique product, to the space, a wearable device. Nobody had ever seen it. So it was easy to get attention. In fact, we didn't talk about this, but as we transitioned from wearables to software, our brokers probably are the most ingrained and stuck in wearables because it's so marketable. It is not implementable to the level we would like, but it is very marketable. And so we were fortunate that we had a unique enough product that, literally it was comp is behind the scenes on paper. You pay claims when they happen. Now you had a product, this is our wearable device that you could go put in their hand. They could go out, put it in a customer's hand. And so that really attracted a lot of distribution. As we've switched to software-based, that distribution side, we were very fortunate. We had distribution channels. We could educate them on the shift. But if we were starting over and trying to explain a data and claims oversight based approach that you can't touch and feel, and you have to see in action, I think it would be more challenging, to be honest, to go get that initial distribution.
Yeah. Adam, what else should we talk about that we haven't talked about?
I think the most interesting, we haven't talked too much about, what Kinetic does. And I'd say the most interesting
I thought that's how we started. Workers' comp, data. So,
what's unique about that, right? And I think what is it that, Kinetic does? Look, every insurance company will tell you they're a data company. So, if you just say data and claims oversight, that's really kind of, that could apply to anybody, any insurance, any line, and probably any competitor of ours would argue that. I think what I've seen that's really unique and maybe very interesting, and not just applying to Kinetic, but I think what we do and really focus on is where we have isolated in comp is the way all of the competition works. And this isn't just comp. This is a lot of lines of insurance. is because of the competitive nature of the lines, you end up with few underwriting advantages, and where they try and get most of their advantages on the expense ratio. And so by bringing down their expense loads with all the tools that I'm sure you've interviewed thousands of people around, the idea is that you can bring down that expense load, maybe find some happy medium between your loss load and profit margin, and go a little bit higher on your loss load, but still find some more room in your profit margin and get this huge growth in the business. And what that has created, I think, especially what we've seen in workers' comp, is an attitude of putting as much work as you can on the people in the system for your expense load to come down as much as possible. And so, if I look at our competition, for example, they're putting 300 claims on an adjuster at a poor service. This would be a poor service, but a very big carrier, we know. And then if you go to maybe best in class, where they're not as sensitive on the expense load and they really haven't let that suffer, but they are more expensive from a premium standpoint, they put 100 claims on an adjuster. And that's how they've controlled this. And you can see that across adjusting, you can see it across underwriting, you can see it across kind of all the facets of a business to max, to get the expense load as low as possible. You just put as much throughput as you can on a single person. And what we have done with software and really the data fusion side is this idea, very centric on claims, but the idea of how would you manage a claim if you just had one adjuster working one file, which would never scale from an expense load standpoint, but does scale from a software standpoint. If you can have the visibility on what's going on with a claim and have the time and actions you can take through software that an adjuster would do if they only had one file on their desk, that's something really unique. And I'd say that's probably the most interesting thing I've seen across all the spaces, and it extrapolates beyond the adjuster, extrapolates beyond comp, which is this idea that the way I see MGAs and the value that can be provided is all the legacy competition is squeezing expense load down, and as a result doesn't have the experience for the customer really in mind as they limit the expense load. And the pockets of opportunities are in these lines and in these manpower organizations of how could you do that job as if there was just one task, one file being underwritten at a time, one claim being managed at a time, one, billing, being managed by one person. How can you run an experience with software across that? And that's where I think all these facets of opportunities are for the MGAs / even the technology providers as they think through their products. They're so focused on efficiency right now. And to be honest, I think they miss a little bit of the mark in the sense that you start with customer experience, make the customer experience the best part. And if efficiency is part of it, great, but people, like, where you're going to win is customer experience. It's not so much on like squeezing down your expense load by another half a point.
I really want to start, there's much to say about it, but then we open up, examples of Hippo and Lemonade and the difference between their loss ratios and the customer first, and the jokes that they were at the beginning that Lemonade's original chatbot was like a counter of 3 seconds and then claim approved. Now go tell everyone else that we are suckers and we pay every claim. Jokes. We have no idea if it's real or not.
Right.
Hippo, it took them, I don't know if they are finally profitable or not. I think that they are still, their combined ratio is in the hundreds or 200s, or it used to be 200s. I need to check. I didn't check it for many years. The only ones from the early generation, kind of InsurTech's early generation, I think it was Root that kind of got their shit together, done a good job. But
yeah, and they paused growth for a while to do that.
Well, part of it was thanks to their relationship with the Carvana, if memory serves me right. But again, I've been out of the loop. Out of the loop. I haven't paid attention to them for a very long time. So as a result, me mumbling here about that.
But I think you're right. It's a good counter to only focus on the customer experience. I would say you have to do that in light of what we said previously, which is if you don't have strong capacity relationships, which are driven by underwriting profitability, there's no room to fix the customer experience.
Oh, no.
So what, like, you won't be around. You're going to go out of business in this day and age. And so, you might get, I've seen it in comp. You might be around for a couple of years because it takes an actuary that long to figure out that your loss ratio is 160%, but you're not going to be around, for a long time. And so I think when I think about all those opportunities, I'm starting with the assumption that you're already working out of a sound model that has profit margin in the system.
Oh, that's critical.
That the competition and really like the landscape of competition in comp, where we play, when we look at our competitors and we talk about these expense loads being squeezed, and how we look at that, but, kind of say, how do you manage that with software so you can squeeze an expense load, but really elevate the customer experience? It's with the assumption that, we're comparing to companies that are running, 10 points of underwriting profit in the system. So like, you don't want to start in a system where it's like, hey, we elevate this customer experience and we run 150. Well, great. You can elevate the customer experience for the next 2 years. You're going to be out of business. That's you're going back to your point of put $1 in and you got to know, $1.90 comes out. That's put $1 in and know you're getting 30 cents back, in the system.
And don't forget that you need also a little bit of capital for compliance reasons. So that's the entire regulated capital that you have, which is on the side just in case that you need to actually pay. But it's only a part. But that's already part of that black box. So we've been talking for a while, and it was such a pleasure. So before we say goodbye, we start to talk about software, the data, the everything, which as always, and we kind of hinted at the beginning, if you're following the IGV or anything in the public sector nowadays, and again, we are recording this April 2nd, so things may change, and always remember that in the context, beside AI, Anthropic, and everyone, we have also a war in Iran that is going on. Who knows, tomorrow maybe it will end or will continue for another year. No one knows. Well, maybe a few, but not me. Data, software, which is the classic cue for AI. So, are you an AI company or just using ChatGPT when you need to improve your email?
I would say on a spectrum of, let's call 1 using ChatGPT to improve your company or improve your email, and 10 being AI. There's no employees and AI agents are running everything.
I can show you the stack of McMinis. Yeah.
We are probably around a 5 or a 6. We use AI for a lot of processes. I mean, case in point, we have a big internal effort to see, because we have all this data and because we are touching services and software, we have a big need to see across the organization at an account level, what has happened. Have we reached out for loss control? Have we done loss control? Have we done a claims review? Are they using our products? Are they, what's happening at the adjuster level on these claims? What have our AI agent bots that are touching aspects of those claims doing? And getting a global view for an account. And we had, a person in our team in the last, we identified that problem on Friday, and we have a working hosted platform running today. That is because we use AI from a development standpoint and have it very connected to all of these systems, Salesforce databases, emails, you name it. That's impressive. That is something that, I'm very, like, the speed with which you can really get some of these problems solved across big data sets is something I think we do really well. But I wouldn't say, look, we have people underwriting everything. We have AI agents helping a lot of communication, but at the end of the day, if we see 3 back and forth emails where something's not resolved, it gets elevated to a person. We have AI has helped a lot in our claim system in terms of digesting claims notes and feeding that as one component of the data in our system that I just mentioned, kind of that global view of how things are going. So I would say AI is accentuating a lot of our processes and driving some of the value into our system, but it's still very much, insurance. And I don't want to say this because I hate hearing it, but insurance is a people business, and for our relationships and key things, we still use people for a lot of checking. Now, will that change in the future? Maybe. But I don't think a lot of our customers, especially on the brokerage side, are ready to talk to an AI bot all day.
Oh,
Especially at the risk and commission levels we're offering. When you're talking about a real paycheck on the bottom line, I don't think they're interested in kind of just talking to a chatbot. So I think I'd give us a 6 out of 10. In terms of, are we an AI company? We use components of AI, but I wouldn't call it AI insurance by any means.
Use AI like any other company to improve your efficiency and productivity.
Yeah.
That's it. Yeah. No. Yeah. Awesome. Great. I think this is great. Adam, it was an honor, a pleasure to spend almost an hour with you. Thank you very, very, very much for joining me today to talk about Kinetic, the journey, giving a few tips to different startups that are on their path. And there are so many other things that we didn't even touch. People most likely will have. So, okay, you had nationwide. What if I'm not so lucky? How do I get, a battery of different capacity providers? How do you move from 1 to 5?
We've done it. We've explored everything. So if anybody has questions there, feel free to email me, adam@kineticomp.com. But it's, happy to always help anybody starting in this industry. And your show has been a great, platform for getting information out there as well.
Thank you very much. Ciao.
Take care.